Welcome back. The other day we spoke a little bit about the moving averages as they apply to the S&P 500, and one of our viewers had a very interesting question regarding whether the 5200, I believe it was or 9200 crossover, moving average crossover would work well for the NASDAQ. And I think the answer is probably a little bit more complicated than simply yes or no. So I wanted to use the NASDAQ as the example to try to answer this question, because I'm sure many others of you have wondered the same thing. The black line here represents the NASDAQ. This goes back to 2014, and we have a number of different moving averages. No moving average we chose for any particular reason, except they're pretty common levels. The 10 simple moving average, the 30, the 80, the 90. The 90 and the 200 are very popularly used. Now, there's a number of different ways we can use moving averages. We can use it in a trend following system. We can look for crossovers, look for buy and sell signals. There's no end to the way we can use these. We're going to try to touch in just a few. Let's zoom in on the trending market, the uptrending market that occurred between 2016 and 2018. Now, I'll preface all this by saying that in my experience, the best and probably only way to use moving averages is in a trending market. So if you have a market that's range bound, it's not able to accomplish new highs or new lows and just kind of bounces around, I don't think that moving averages really has a lot of use in that type of situation. But if we have a trending market situation, especially an uptrending market situation, I think moving averages can be used very well. Downtrending markets tend to occur too quickly. Uptrending markets are more slow in their development, and it gives us time to get in and out of trades. Now the question is, what's the best moving average? And the answer is it's always different. But we use the moving average, in my opinion, we use the moving average that best captures, that best defines the market. So in this example, the black line is the NASDAQ, again, from July 2016 through September 2018. And for whatever fundamental reason, the market was going up. We went from 5,000 to 7,500. Now, let's say we were bullish. We looked at the economic numbers and we said, okay, I want to buy stocks. Well, we want to buy stocks when the market comes down close to the moving average, and then place our protective stops below the moving average. Because in other words, the moving average defines the market. It defines a tendency for the market to go up 3 points and then retrace 2. Go up 3 more points, retrace 1. The moving averages serve also as a tool to us to identify the moment when the market changes course. Think of the moving average like the average temperature in the summertime. The average temperature in the summertime could be 85 degrees. Sometimes it'll be more than that, sometimes it'll be less. And, one particular good or bad day does not define the trend. But if all of a sudden we start to see 2, 3, 4 consecutive days when it's 50 degrees out, 40 degrees out, that's a pretty good sign that the summer's over. And we can get obviously a lot more micro with our analysis. Well, the same holds true for the stock market. So let's pick a level that we think best defines a market. And, for me, I think it's the 30 simple moving average, the dark red line. The black line, again, is the NASDAQ. The reason why is because if we go for a longer term moving average, like the 80, which is this thin orange line, and I made it very thin not to distract us, it's too far away. The market doesn't come down to this level. We want to find the moving average where the market tests repeatedly but fails to really break through. So the 80 is too far away. Now we have a very thin line that's hovering right on top of the market. That's the 10 simple moving average. That's too short, because we can see the market jumps above and below, above and below. If we were to buy near the moving average and place our protective stops below, well, we probably would have gotten stopped out quite a few times. So in my humble opinion, I think the 30 simple moving average, the red line, best defines this market. We can fine tune this. We could say maybe a 35. We can always adjust this. But generally speaking, the 30 seems to hold it very well. Why? Because around December 2016, we could buy the NASDAQ when it hit the 30 simple moving average, around 5,200. The market rallied up to 5,400 or so. As far as taking profits, there's a number of different approaches. We're not really going to talk about that here because that would employ other areas of technical analysis and money management, etc. But just simply, where are the buy signals? And I only say buy signals because the trend is your friend. And when we have a strong trending market, I believe the best strategy is to only place our investment capital in the same direction as a long-term trend, in this case, the upside. Now, there are several times you see the black line, the NASDAQ did fall below that 30 simple moving average. Protective stops placed with a little bit of room would have survived. Stops too close would have been stopped out. But then again, we had another chance to get back in when the market crosses back above the moving average. And it gave us quite a few times. Now, how did we know the 30 was going to be so good? Well, we didn't know, until we looked back at the chart. But then again, if we jumped into the market, let's say right around here, let's say July 2017, we would have seen it had worked pretty well so far for the past year or so. The 30 simple moving average had worked pretty well. Now, the 30 simple moving average in this particular case best defines the rate of incline, the rate at which capital is being committed to the market. It is always going to be different. There are always different fundamental forces out there, different levels of interest rates, different political, geopolitical forces out there that are pushing stocks one way or the other. That's why I really don't believe that there's a magic, level. Now, with that said, going back to the viewer's question, the 90, I believe it was a 90-200 crossover, there is something to be said for those very commonly used moving averages, like the 200, like the 90, and when there is a crossover between, a very well-known crossover, very well-followed crossover. But in my humble opinion, at the end of the day, I think that the best way to employ the moving averages is very simply find the one that at the moment best defines the market, because it tells us when to get in. It tells us when the market's really gotten kind of parabolic. Take a look at January 18, where the NASDAQ had rallied from a level around 6,500 up to, that looks like it's almost 7,500, where the moving average was at 7,000. We were 500 points above the moving average. Maybe another rule that could be applied is to take profits when we really start to drift away from the moving average. And this very large rally to the upside was followed by a huge sell-off, which eventually did break below the markets. Maybe that's another trading rule. If the market gets really parabolic and starts to pull ahead of the moving average to such an extent, much more than it did in the past, maybe it's a good time to stay away for a while. As they say the analysts say on TV, the markets get volatile. Volatile markets, in my mind, are a danger sign, even if the market's still going up, because this is why. It starts to get more volatile. And when it's volatile going up, it'll be volatile going down. And then eventually, of course, the moving average does us the final favor and tells us when not to get in anymore. And it also gives us a discipline. Don't buy the market below the moving average. If we do, we're buying something that is not behaving as we would like it to. Here's another example. This is 2020, 2021. Now, the 30 simple moving average is a red line. You can see in this case, it did not work very well at all here. No moving average will last forever. In this case, the dotted purple line is the 80 simple moving average. Now, we could argue that maybe this is too wide of a moving average. The market didn't test it in September of 2020. It almost touched. This is November of 2020. It became a little bit more consistent further on, but it did not give us a lot of chances to get in. And it really is up to you how close you want that moving average. It's a balance. It's a trade-off. The moving average is too far away. We're not going to get a trade signal. We're not going to get an entry signal. If it's too close, we're going to get too many crossovers. Maybe the 80 is a little too far away. We know the 30 is too close. Maybe a 50 or a 60. I'd probably guess maybe a 60 might be a little bit more appropriate. By the way, take a look at this green line. This is a 200 simple moving average. There's a lot of traders out there that won't buy the market below the 200 simple moving average. There's a lot of statistics that show that if the market's below the 200 simple moving average, it's not going to fare well. Maybe a trader would only choose to get in once we cross back above. Fast forward to present day, we've seen very choppy markets, and you can see why moving averages, in my opinion again, are not best suited for choppy markets. This is why. The dotted purple line is the 80 simple moving average. It's too far away. The 30 is the red line. The orange is a 10. There's really nothing here. And we see a whole convergence of the 90 and the 200. I don't know that there's a trading signal out there or a strategy out there that would keep us into trades. Now, if you're a short-term trader, take a look at the 10 simple moving average. We could say, well, I am very skeptical. The market seems very choppy, but I'm going to look for little scalps along the way, maybe little day trades or swing trades. In that case, we could use a 10 simple moving average very recently. We actually just bounced off 12,400, 490 or so in the NASDAQ, and now we're back up to the 12.6, 12.7 level actually. So there is something to be said about shorter-term moving averages when the market's choppy. But overall, we can see this is not a fun market. In this type of choppy market, I think that the Bollinger Bands would probably be much more aptly suited for this type of market, because the Bollinger Bands, I think that are better suited for a buy low, sell high, range-bound market. Moving averages, that's when everything seems to line up and the market's going really smoothly, and we say, well, I know what stocks I want to buy, and I have a good level of confidence. The economic numbers look good, and low interest rates, and I want to try to jump in. Well, this gives us the basis to do so. But again, the technical indicators, they not only serve as the trigger that tells us, okay, buy here, sell there. It also allows us the discipline, or it provides us a way to maintain discipline to say, okay, well, this is a trending market. We know trending markets are good for moving averages. Now, fast forward to present day, this is a choppy, range-bound market with a slight, trend to the upside. We may be tempted to get in because we see the numbers over the past couple of days are inching higher and higher. But the moving averages in this case will remind us, there's a right place and a right time for all types of trades, and there's also very wrong times as well, to do so. So I hope this addresses the question in a little bit more detail than what we could have responded otherwise. And we're going to continue to touch on some other technical subjects from time to time. If anybody has anything in particular you'd like to talk about, we'd certainly be very happy to touch on those as well. We hope this has been helpful. We look forward to seeing you back soon.